right, guys, I am bringing back, you guys like this, I think. I am bringing back the old going for the gold dragon of chaos. Why tackle trading? Why our step swing trading system? And, we've been swing traders for a long time. In fact, that's kind of really how I cut my teeth as a trader and investor. Is I just had a really kind of short-term perspective. I came to the markets looking to get rich quick. Me personally, I started trading back in the late 90s. I didn't get educated until the early 2000s. But since about 2000, somewhere between 2003 and 2005, I started getting traction and was able to implement and learn and master some swing trading systems that I learned from people who had already done it. That was really an important thing for me. And I'm going to just talk to you about some of the challenges I face. One of the things I learned about the markets and technical analysis, I mean, Matt calls me the technical wizard. But the truth of the matter is technical analysis is a tool. I used to think I could predict the future with it. I used to think I could actually, literally, if I just was a good enough technician, I could predict the future. And what I've learned over the years is technical analysis can give you an edge. It can help you improve your probabilities, but the market's going to do what the market is going to do. And I like to refer to the market. We always talk about chasing the dragon. The market does still have chaos and random movements. Like there's just no ifs, ands, or buts about it. The best technical setup in the world can fail. And I think one of the keys to success as a trader is not what to do when things go right. I mean, that's important. It's how do you manage yourself when things go bad? And where traders get into trouble is they don't have a game plan. And when the dragon of market chaos hits them, when they get hit with like random volatility, like gold yesterday was a perfect example of that. All of a sudden, wicked sell off in gold, and it catches people off guard. And you need to have a plan for that random chaos and volatility. Fear of markets. When you get into that fear aspect, those are really the only two emotions in the market are fear and greed. And they really affect people. I mean, me personally, I'm a very emotional person myself, and left to my own devices, I get as emotional about trades as anybody else. But what helps me sleep at night and what helps me impose some order on the chaos is having a system. The market does go through periods of unexpected volatility. You'll have things from trade wars to tweets and retweets that can affect market prices, Fed talk, the coronavirus and the vaccine talk these days. And then there's always just that unknown. You always have that unknown aspect of the markets because, my ability to predict and forecast the markets using technical analysis is at best short term. And I have no idea what the market's going to do a week from now, a month from now. I mean, anybody who tells you otherwise, that they have some sort of magical system that's right, 100% of the time or 80% of the time, they're probably full of it, because that's not how markets work. Markets can do anything. New information can change sentiment quickly. And again, just look at the last year, just year to date, for example. We've had about every kind of market condition you can experience. So we're going to talk about how to impose some order on that chaos. And I think one of the biggest problems traders have is they don't know how to manage their own emotions and mindset. And their subconscious mind and their emotions become kind of enemy number one for traders. And a couple of years back, I stumbled across prospect theory after reading some books by guys named Daniel Kahneman and Amos Tversky. They won the Nobel Prize in economics for prospect theory. And they basically mathematically proved that people are wired with loss aversion. And when we approach the markets as traders, we run into loss aversion. We don't like losing. So what it comes down to is when you have this loss aversion, it's just as simple as nobody likes losing money and nobody likes being wrong. Your egos get involved, but ultimately we literally feel losses differently than we feel gains. And when you could frame this type of question for somebody like, if I could give you a 50-50 bet, odds on probability that you could risk $100 to make $100, and the odds are 50-50, most people won't take the bet. In fact, I would dare say well over 80% of people, if given a 50-50 shot at making or losing $100, won't take that bet. But if you were to change the framing where, say, okay, you did take the bet and you lost $100, you got, tails instead of heads, and you're down $100 and they offer you the exact same bet again, 50-50 odds, make $100, break even, or lose another $100 and be down 200. And what happens to people is that same group of people that are risk averse, that wouldn't take the 50-50 bet to begin with, when you change the framing and the context of it, when they're down or they're losing, they all of a sudden become risk seekers. And the vast majority of people become degenerate gamblers when they are losing, not when they're winning, when they are losing. And so prospect theory is, again, they won the Nobel Prize in economics. And when you're winning, you get a little bit of a diminishing sensitivity. It's like, oh yeah, I made $100, I made $200, I made $1,000. I mean, it starts to lose its luster a little bit. And you do get excited. You feel euphoria when you're winning, but emotionally, when you're losing, the distress, dysphoria that comes along with a losing trade. Now, how many of you out there, by the way, have experienced those losing trades and done something dumb, panicked, felt it? It's just, you don't act rationally. And so ultimately what it comes down to is people, when it comes to trading, your break-even point, your reference point, whatever you paid to get in or out of something, that's your reference point. And whether you're winning or losing, the most important thing you can do to control this emotional response, which is innate, I think, in everybody. I've only met one or two sociopaths, quants, that have the emotional makeup to just be good traders right out of the gates. And the rest of us, human beings, not the robotic types, really struggle with this concept. And it's really hard to learn. In fact, one of the things that I always joke about when I'd be teaching people how to trade, whether it was personal coaching or mentoring with people over the years, is I totally just forgot what I was going to say. The joke I would make with people is I literally have had a brain cramp almost. I don't know what I was about to say. Just slipped my mind. That just, again, when you're gonna face losing trades, and the biggest lesson, it came back to me. I remember now. The number one thing you can learn to be a good trader is how to lose. I'm going to repeat that. The number one thing you need to learn to be a good trader is how to lose. And to lose when you lose on your terms, not the market's terms. And hopefully that makes sense. Because is taking an expense trade or losing trade inevitable? Absolutely. It's going to happen. It's your ability to keep a small loss from turning into a big loss that preserves your capital and keeps you in this game long-term. So that's what we're going to be talking about, is, how to get over that drag. That it's your internal dragon of chaos. It's not even the market's chaos. That's one challenge, but it is that in, your ability to control that internal dragon of chaos, just your own mind, your own feelings, and your own emotions. And, if you want to be able to slay the dragon and get the gold, because, that's the kind of the archetypal story right there, is if you want to get the gold that the dragon is protecting, you have to go through and face that dragon. You actually have to go through, put in the time, effort, and energy, and overcome your fears and missteps to slay that dragon and get that gold. So that's what we're going to be doing here. And we're going to get in and talk about it from, conceptual standpoint, and how we go about that to vanquish that dragon and get that gold. You need a system and rules. And when you get that system and rules under your belt, that's the key. So what we offer over at Tackle Trading, and what really helps people, is we put out scouting reports every week. Now, that's kind of the fuel that feeds the fire. You have opportunities. You have opportunities with your pro subscription. You get the stock report, you get the options report. We have that weekly newsletter, commodities report and Forex report, and just things to help you be in the right place at the right time. And, our scouting reports and our stock reports have pretty good track record. They don't all perform when a lot of the stocks will actually lose, but it's that given, it's a time-saving mechanism that helps you find really great opportunities. I'm going to show you a couple of examples here in a moment as we get going, where I'm going to pull the candidates right from this week's stock report and options report and show you how they're performing. And then you need a system. And we're going to be talking about the STEP system and how the STEP system works. And the STEP system it stands for, stop loss, target, entry, and position size. And if you can cover those 4 bases, having a good stop loss in your trade, having a reasonable target, knowing when you're going to pull the trigger to enter the trade, and the proper position sizing so that you can control and manage that risk, that's what it's all about. And so we have an entire system built around swing trading, and it can be used for swing trading stocks. It can be used for swing trading options. It can even be adapted into things like position trading and investing once you understand those core concepts. So, by the way, how many of you have been through the STEP system, by the way? How many of you have actually, Tackle Pro members out there, I know we got a bunch of them, have actually gone through, taken the STEP system training, learned the rules, learned the concepts, and have been able to go? I mean, just how valuable is that for you is kind of my big question. So, yeah, and it's awesome. It's awesome training. So the cool thing about the STEP swing trading system is that it exploits one of your natural abilities. You are, as human beings, we are natural pattern recognizers. It's just what we do. We recognize patterns. We are so good at recognizing patterns that we actually have to be cautious that we don't suffer from what's called apophenia, which is where you recognize patterns that aren't really there. That's where like conspiracy theories and things come from. People recognize patterns everywhere, and then they kind of like put things together in their minds automatically, and then they can see things out there that may or may not exist. But we're really, really good at recognizing patterns. And so the STEP system is going to take a natural ability you already have and help you tap into that and exploit some of the probabilities that the patterns in the markets give us. Now, just to kind of prove a point, you have good pattern recognition. You guys can see the patterns here that reveal the potential danger, right? You guys can see that coming in. You can spot that. What one person might see as a pile of leaves, everybody else can see that dangerous predators. In fact, that's why you evolved to be so good at pattern recognition. You can spot the thing that sticks out. So when you recognize patterns, it's just part of your DNA. And the first pattern you start to recognize in the market's just the simple price cycle. You will recognize what happens when people are buying, what happens when prices are running up, what happens when it goes into a selling phase, and what happens when it goes in a sell-off phase when prices get marked down. And it's a pretty simple little cycle, and it repeats over and over in the markets all over the place all the time. And it's just part of the natural price discovery mechanism in the markets. Prices will go down. People will panic. They'll sell, and it'll go through a markdown phase, and things will get cheap. And they'll oversell. They'll panic. And when it's cheap, that's when the smart money is going to step up and buy. They're going to learn to accumulate while prices are low. And that low price is kind of relative. I mean, we're not talking necessarily just about like value investing. We're talking about like buying the bottom of a dip, buying a dip in a trend. It's the whole BTFD, buy the dip. Then once people start buying, the prices tend to run up, and they go through a cycle of a markup phase. And once you get through that markup phase, prices will run. That's where you can make your money. Eventually, prices will get too high. They'll overshoot. The emotions get caught up, and prices run too high in the short term, and it'll get overextended, and it'll go through a short-term phase of profit taking or distribution. And it'll go after people realize that they're starting to sell, you'll see a markdown phase, and that gives us another opportunity to buy on a dip. And when you look at that, how this pattern plays out in a trend, you can kind of see how that price cycle moves and prices oscillate. Like you'll get an accumulation phase, prices will run up, they'll get overextended, they'll go through a sell-off phase. And when you go through the markdown phase, people will step up and buy at higher prices because they like it and they missed the previous run. And so they'll get excited about buying at that higher price and get a higher low. And then during the markup phase, it'll take out the previous, resistance threshold, and you'll see markets establish new highs before they start to sell off again. And you just recognize that basic pattern. It oscillates up and down. And as soon as you see a price chart, you're going to recognize how the pattern works. And the whole idea with swing trading is to trade with the trend. You just got to learn. How many of you have heard this before? The trend is your friend. It's really important to trade with the trends. Some of my worst trades, and I don't know about you guys out there or any of the other coaches out there, some of my worst trades that I've ever placed that cost me the most money in stupidity points were contrarian trades against the trend. And especially when I was newer to trading, like I would find something that I thought was overbought or oversold, and I would try to take the contrarian side of it.
No, like last year, Beyond Meat, I thought this is stupid. It was a ferocious uptrend. I tried to be smarter than the trend. It was my worst trade in 3 or 4 years.
Yep. And it's temptation because you know that, oh, I can time the markets perfectly, or I can catch that dip. And trading against the trend is a sucker's bet in the long run. Trading with the trend and being patient with the markets, and even allowing like a swing trade to mature into a position trade, or to scale out and let some of your profits continue to run over time, is how you build wealth. How you build wealth over time. And so we're trading with that trend, and that's how we're going to tame the dragon. Is we're going to learn to trade with the trend, and we're going to impose some order onto that market chaos through our discipline, because we can't really control the outcome of the market. The market's going to do what the market's going to do. We can trade with the trend, and even during an uptrend, you can have something like that happened with gold the other day. Yesterday, it was just a sudden sell off, boom, and then people are buying the dip today. And when you learn to read the signs, you can kind of see it. Now, the uptrend of higher highs and higher lows is really what we're after when we see this the way the cycle works. You'll see those higher highs and higher lows. You'll see the uptrend in general. And the name of the game is to buy the dips and buy at the bottom of the base of the trend line, and to buy breakouts, and then to take profits when you get sell signals. And your sense of timing gets better and better as you trade more and more. However, even as a seasoned veteran, I don't think that you ever master timing. You get good at it. You get really good at it, consistent at it. But at the end of the day, you can have a really great looking technical setup, and then information or market sentiment changes, and the pattern doesn't play out like expected. You get improved odds, you get favorable probabilities, you get to control your risk on a nice entry. But at the end of the day, technical analysis. So there's a reason people poo-poo technical analysis from time to time. There's the fundamental type investors out there who only want to invest on value, only want to hold long term, and they laugh at us technicians for thinking that we can somehow divine the future. And anytime I see somebody out there claiming to be a guru that claims that their patterns work 100% of the time, or irrationally high number, like 80-90% of the time, that's kind of that's to me untenable. I think a really good technical setup gives you odds, probably somewhere like between better than 50% up to like 60-70% probabilities of outcome. But that still means you have a 20-30-40% chance of the trade going against you. And how you behave when a trade goes against you makes the difference of your success at the end of the day. So we're going to learn how to capture the timing mechanisms that are available to us, and how to learn how to buy the breakouts and buy the dips. Now, if we can identify that stair-stepping pattern where we see higher highs and higher lows, where we can buy the breakout, where we can buy the pullbacks and catch those old support resistance bounces, we can add, tools and indicators to the charts to give us more examples. And we're going to go through a couple of those examples, again, this week from the scouting report. So Swin asks a great question here. How do you reconcile conflicting advice? The trend is your friend versus be a contrarian, or when it makes a new high, it's time to buy versus wait for the pullback. One, take all advice with a grain of salt, Swin, even my advice. Two, practice till you get comfortable with the system. And then eventually you'll get to the point where when to, when advice makes sense, or when to discount it, because that's where your experience comes in. And even as an experienced trader, do you think every once in a while I'll get, I have followed stock tips from other people and looked at the chart and been like, okay, that seems like a reasonably good trade setup. And been right and made money. And I've also done that exact same thing and been wrong, that, the outcome didn't come out as expected. So that's why it comes back down to your game plan. Like, can you heed the random advice that you get out there? Sure. How much you willing to risk to find out is ultimately the question you have to ask yourself on any trade. Is that going to be good advice that makes me money, or is that going to end up being bad advice that costs me money? Only the market will tell, right? So at the end of the day, if you can impose your own order onto that chaos or into that random advice, then you can take and heed such advice. Otherwise, I think one of the most dangerous things in the world out there is a guru who puts out trade advice. And I use the term guru, lightly, without giving people rules and discipline and what to do, because that's how people blow up. That's how they get in trouble. Yeah, buy low, sell high, right? Buy the dip, sell the rip. It's just that easy. You got it. You'll make $1 million. Just do what I do, right? At the end of the day, it just comes down to that ability. So this is the core pattern you guys need to know. And this answers your exact same question. Okay, in an uptrend, I am a strong believer that you buy the breakout. So when you've heard me say things like this, when the stock breaks to a new high, it's time to buy, right? When a stock breaks the resistance, you buy. What do you do when the stock breaks the high? It rhymes. You buy. It works every time, except for when it doesn't. There's a fine line between a breakout and a fake out, but odds of probability are, and if you look and study enough charts, breakouts tend to work until they don't. And a breakout's one of my favorite patterns in the world. You need to check the volume, you need to check other indicators, but even if you do all those things correctly, Ahmed, are you going to be right 100% of the time? Or are all you really ultimately going to get is an improved probability of an outcome? Better than 50-50 maybe. You have a pattern that breaks, it tends to send the market into a certain psychological sentiment, and a mechanical response to prices breaking to a new high. And you can catch a breakout. I mean, you can get a really good run. Usually on a breakout, you'll see quiet volume prior to the breakout. I love this question, Sleepy Hacker. And I'll tell you a quick story that I like to use to illustrate that point. When I was a kid, I grew up in Salt Lake City, Utah. We'd go up in the mountains in the wintertime and we'd go find big ski jumps to go off of, big cliffs, big ski jumps. We'd get up on top of those big jumps and steep precipices, and we'd look over the edge and say to ourselves, I'm going to die if I do this. This is dangerous. This is stupid. Tell you what, you go first. I'd tell my buddy, you go first. And if you don't die, I'll go second. And nobody wants to go first. Like, who wants to be the first person to buy the breakout? How many of you love the idea of buying a stock at the all-time high? Like, this stock has never been this expensive before. I'm going to wait until it becomes the most expensive price it has ever been, and then I'm going to buy. How many of you are like all in? Like, I'm going to buy that stock at the most expensive it's ever been. I'm going to do it. Who's with me? And how many of you are just kind of like, maybe? You go first, Noah. And if you don't die, I'll go second. That's what happens right before a breakout is everybody's playing wait and see. So do you see high volume in anticipation or low volume? Like, everybody's watching, waiting. Nobody wants to buy before. Everybody waits for confirmation. Everybody wants to wait to see if it breaks out. Most people are going to wait. Okay. And I've done it both ways, where I've bought before the breakout and I wait for confirmation, and I've experimented with it and tested it both ways. And once it breaks out, the odds of probability improve. The odds of it continuing to run go up. But you are paying a little bit more money for that assurance. And it's an interesting psychological, but what happens when it does break out and everybody gets that confirmation, everybody who's waiting on the sidelines to buy, what do they do all of a sudden? When they get the confirmation, when their buy stops get triggered, what happens? I'm waiting until somebody answers that question. And I know somebody knows the answer there. They buy. And what happens to volume and participation levels? All those people waiting on the sidelines get the confirmation and boom, they buy, the volume and participation goes up. So what the typical pattern is you want to see strong volume on a breakout, but it's usually quiet volume before the breakout. So that's the first pattern. Then there's only 3 technical setups. At the end of the day, guys, there's only 3 technical setups. The first one is the breakout. Buy when it breaks to a new high. And it doesn't have to be the all-time high. It can be any resistance zone. And when it breaks resistance, it's a good time to buy. When it breaks to a new high, it's time to buy. Prices will run up, 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 up. And then what happens is the short-term smart money is going to do what when they reach a profit objective? What's going to likely happen when the smart money who buys the breakout reaches a short-term profit objective? Gets overextended, you're probably going to see a sell-off. They're going to take profits. And so at stage 2, the tendency is you'll see a reversion to the mean. Prices will revert back to the mean. So breakout 1, buy. When you get to that profit taking, unless if you're a swing trader, this is where you take a profit. This is where you trail your stops and you get stopped out of the trade if it reverses. This is where you scale out, take some money off the table, or where you adjust the trade to reduce your risk. Okay. And then you've all heard this before. Hey, if you missed the rip, if you missed the pop, what do you do? If you missed the pop, wait for the drop. So when you get to that next setup, this is called the pullback. And there's an opportunity to buy when you get confirmation up. And so that's basically swing trading in a nutshell. There's only 3 technical setups that I find worthwhile. Breakouts or down to on the bear side, it works as well. But we're going to focus on the bullish side because the Fed's got our back, right, Mark? You got the breakout.
Yes, it does.
Yes, they do. Stonks go up. So breakout buy, learn to take a profit, scale out, adjust, trail stops so that you can lock in a gain for swing trading. If you're going to be a position trader, you have to be willing to endure the drop back because the odds of probability are it's going to come back down at some point in time before it continues to run up on the trend. So the best times to buy are breakout 1 and retracement 3. And what you want to avoid is buying something that's overextended or overbought. And you'll see this all the time where people see a stock ripping up and they'll buy it at, on the momentum and the enthusiasm, and they end up catching it off of a high price and they get caught in the pullback. And so that's, again, common pattern. So these are the things that we're looking out for on a pullback setup. So stage 3 pullback and we're going to talk about breakouts and pullbacks. And the primary qualifications for a pullback and secondary qualifications for a pullback, and then planning and prepping your trade are basically the 3 steps you need to go through. You need to look at the core chart. You can use secondary indicators and qualifications to help you filter out trades. And then you need to plan and prep your trades and use the step system before you go pull the triggers. And the first thing you want to see is an existing bullish uptrend. You don't want to be trying to pick off bottoms. I mean, you can, that's one style of investing and trading. But the truth of the matter is most of the time you just find something that's in a good trend and you can buy it in the uptrend, a longer term uptrend, even if it goes through a shorter term correction that can last weeks or months, kind of like you saw back when COVID melted down. There was a pre-existing macro uptrend that gave people the opportunity to buy the dip. You need liquidity. You got to stick with stuff that's liquid. You can't trade illiquid stuff. You avoid penny stocks. They're trash. You're probably better off staying above $10 on stocks, maybe $5 if you're looking for super cheap stuff. But they got to be super, super liquid, and you want to find, stuff that's, I'd rather trade something that's got fundamental strength that everybody wants to own, and you can think of those types of stocks. Find those because they're going to have the trends and the liquidity you're looking for. You need to see a good corrective retracement. You want a technical catalyst to give people a reason to buy, either an old support resistance zone, a trend zone, a moving average, a pullback to like a 9-period moving average or a 20-period moving average or a 50-period moving average. When you see those opportunities, those catalysts help prices run back up. And so if you can spot a bullish uptrend on a liquid stock that's got a nice pullback, corrective retracement, and there's a technical catalyst there, you're starting to get some things that'll improve your timing. And then this is where like your signal candles come in, like a hammer or a doji, you know, a nice green candle that gives you that signal that, hey, the selling cycle might be coming to an end. It's time to buy. And then you get that confirmation candle. And that's what you're looking for, is those 6 core conditions. And once you get those 6 core conditions, well, and you can train your eyes to see those all at once. You're going to want to probably run your trade through secondary qualifications. Like, hey, make sure it's got a nice longer term uptrend. The sector's performing well. You have like a, you know, maybe an indicator like an RSI or an oscillating indicator that you can use to help you filter out stuff that's overbought or overextended or, you know, overvalued or doesn't have the right strength. I think sector correlation is huge. If you can find those kinds of stocks where you see the entire industry group kind of marching in lockstep, where they're running through the same buying and selling cycles, it gives you an idea of how institutions and algorithms are treating that group. And you try to look for the best looking candidate. And a good example would be like, oh, hey, you know, I'm interested in semiconductors. Well, if I look at all the semiconductor companies, and I see AMD and I see Taiwan and Micron and micro, you're going to see those candidates moving, and then maybe the outliers like Intel's not marching in step. Well, I'm going to go with the stocks that are marching in step, and I'm going to try to pick the best looking candidate out of the group and try to take advantage of the overall sector and industry group trend, and then pick my favorite candidate from the group. And that's really, really huge. And then you got to watch out for things like earnings. You know, swing traders' earnings are rough. I don't personally like to speculate on earnings directionally. I use other strategies for playing earnings. But for swing trading, you're probably best to avoid earnings because it's an unknown that could alter the outcome of your trade. And then I would always want to pick a stock that's fundamentally sound. Like, if you have your druthers, hey, pick a Microsoft, pick an Apple, pick a company that you feel confident in when it comes to having the fundamental strength along with that. Okay. So that's what we're looking for in a pullback. And then for breakouts, it's the same basic thing. We're looking for primary qualifications, secondary qualifications, and we're going to plan and prep our trades. And, a breakout is anytime you get a stock breaking to a new high, breaking above a resistance point, giving you a confirmation that people are buying it. They're paying more than they did the last time it reached that price threshold. And that breakout pattern, like if you can spot a cup and handle pattern or a high base or an ascending triangle, one of the things I love about pattern recognition is if I spot the pattern, do you think Mark spots a pattern too? Or even Tim can spot patterns. I know he can because he does it all the time. If you can spot the pattern, other traders can see the pattern at a certain point in time. Doesn't like a cup and handle become a bit of a self-fulfilling prophecy? Or an ascending triangle, like everybody sees the pattern forming and traders know that pattern. It doesn't guarantee that the outcome, but it improves the odds. It gives you a reason for people to buy. So I love, shorts are a pattern. There's no shorts left in the market. Everybody's running around pantsless, Jimbo. All the shorts got eaten. You want to stick with the liquid stuff, guys. I'm telling you, avoid illiquid stocks, gappy stocks. There's a lot of reasons to stick with good quality companies. Get that price confirmation on a breakout. Avoid the streak. Avoid the breakouts, fake outs. By waiting for that confirmation. And then you want to make sure you've got those positive risk reward ratios. You want to look again for the longer term uptrends, strength and trends. You can use secondary indicators like RSIs or other indicators. If you like an indicator, there's no reason you can't use it. Again, sector correlation, market correlation is huge. And then watch out for earnings. And it's always best to have fundamentals in your back pocket. You want them with you, not against you. And don't pick fights. Like, don't contrarian trade against the trend. It's a good way to lose money. So this is the game plan. And these are the 4 secrets of successfully being able to vanquish that dragon and get the gold. Secret number 1 is, look, This is Warren Buffett's #1 rule of trading and investing. Don't lose money. You'll find opportunities in the market to buy. But if you don't use proper position sizing, stop losses, risk management, adjustment strategies, what have you, to protect your assets, at some point in time, the market can run against you and it can run bigger than you think. And it's okay to have small losses in trading. In fact, that's expected. You know, my favorite trade is a big winning trade. My second favorite trade is a small winning trade. My third favorite trade is a break-even trade. And my fourth favorite trade is a small expense trade. The only trade outcome that's unacceptable is a big loss. You can't let a small loser turn into a big loser, because eventually even a small loss can turn into a big loss. And that's where it shakes your confidence. It hurts. You won't like trading and investing when you get your assets handed to you on a silver, like when you get your backside handed to you by the market. It's not fun. It hurts. It takes a toll on your psyche. And I know a lot of you watching have been there. I've been there. One of the hardest trades in the world for me is after you take a big loss, like pulling the trigger again. Like, how many of you, by the way, have like abandoned a strategy after just taking one loss, like big loss that hurt more than expected? Like, man, I'm never doing that strategy again. Just because it put a sour taste in your mouth. And again, implementing that strategy after taking a loss is hard. But you do want to get back up on the horse. I actually had a student text me today who actually took a big drawdown on her account. She got it back up above. She's in the black and making money. And I was so incredibly proud of her for actually being able to do that, because everybody's done that, where you draw your account down. Yeah. So, and so everybody has that strategy, right? The second secret is learning to take a profit. How many of you have left money on the table? Like, you've been winning in a trade and you let a winner turn into a loser. Or you had a winner and you gave back half the gains, or all the gains and broke even. Everybody's done it, right? And if you haven't done it, you will. Okay. Yeah, greed's irrational. And I've done this many, many, many times, where and the psychology is simple. Hey, if I'm up and I'm winning and I'm up $300 or $400, that feels good, right? You're like, yeah, I'm up $1,000. Awesome. Well, if 1,000's good, isn't 2,000 better? And you're like, oh man, this stock's totally, it's going to 50. It's going to go to 100. I'll finally be able to insert financial need psychology, like whatever rationalization you're using, for that greed. Like, oh man, I could finally get that new living room set I wanted, or whatever it was. That greed monkey gets on your back, right, Jimbo? And you need to learn to lock in those gains. You need to learn to trail the stops. You need to learn to adjust or scale out or do something to put money in your pocket. The third secret is learning to pull the trigger at the right point in time. How many of you have missed the trade? Like, you did all the research, you went through the scouting reports, you ran your scans, you found your candidate, you thought it was a good setup, you did all the planning and prep work, and then you sat on the sideline because you were paralyzed by fear. Inaction robs you blind. The woulda, shoulda, couldas get at you. So you need to learn to automate these things. You need to learn to automate your stop losses. You need to learn to automate profit taking. You need to learn to automate triggering into the trade. Take your emotions out of the equation. And the fourth big secret is position size. Size matters, guys. You've got to position size correctly. You've all heard me say this. And if you're new to us and you haven't heard this before, it's a good thing you're here. There are old traders and there are bold traders, but there are no old, bold traders. There are old traders and there are bold traders, but there are no old, bold traders. How many of you have been guilty of over position sizing, wanting to get rich quick? the greed monster, like, oh, that setup is so good. How could I possibly lose? It just happens. Like it's the most common cardinal sin I see people do is over position sizing. You need to learn to position size to risk. You know what makes it easier for me to pull the trigger on the trade? Knowing my risk tolerance and threshold in advance. Like saying, yep, okay, hey, if I'm taking this trade, my max risk is $100. My max risk is $50. My max risk is $200, $300, whatever it is, their threshold is. If you don't exceed your psychological and accounts personal pain threshold, it makes it easier to pull the trigger on a trade. Start small. You can scale it. You can add to trades when you're winning, but start small. It's just like the game of poker. Mark, you're here, right?
I am here.
I need your commentary right now.
All right.
As a professional card player, card shark, do you have bankroll management techniques?
Of course.
And that's, I mean, pure straight up gambling, right?
Yeah. Whether you're a professional blackjack player, professional sports bettor, professional poker player, money management is one of the keys to the game.
Okay. When do you increase your bet?
As my account size goes up, or when the people I'm playing against are slobbering drunk and can't make correct decisions.
Meaning the odds are in your favor, right?
Yes.
So when you have a statistical probability.
When there is easy money to be had, that's when you increase your bet.
Now, the one problem with the stock market that I've found is you can't bluff.
I've never thought about it that way, but that's an excellent point.
People, the market may have some tells, but you can get those tells wrong in a game, right?
Sure, absolutely.
Yeah. Now, when you go to get into a game, nobody puts all their chips on the table up front. When you buy into a game, what do they call that, Mark?
What's your buy-in amount?
You're buying the ante, right? You got to put the ante in, and then nobody raises until they start seeing the hand they're dealt. Nobody starts putting more money in until they start understanding the probability of their hand or understanding what they're up against, right?
Yes, you put in your ante and then you choose to bet or escalate the bet depending on the quality of your cards. Absolutely.
Yep. So one of the first people that taught me how to trade that I learned from was a guy just like Mark, who was a professional card player. He could go down and make a living playing cards in Vegas. And that's an interesting thing. Hey, did we just lose YouTube? Mine just shut down.
I'm still showing live on YouTube.
Are you? Okay, great.
I got it. I got live on my end too.
All right. Okay. So my other machine, whatever, it just went bye. So I'll have to figure out that logging back in. But point is look, when you're in a trade, hey, start small. Start out putting the minimum amount into a trade. And it's so much easier to pull the trigger when you start small. And then once you're winning, once it's moving in the right direction for you, you actually have showing some profits. It's easier to add to that trade once you're up. And one of the bigger mistakes I'll see people do is they'll cost average on the wrong side of the trade, Mark. They'll throw money at it when they're losing.
Of course, yes.
They'll double down. And, when they get caught on the wrong side of a trade, that kind of psychology gets people wrong. So this is what we're after. Again, the market's going to do what it's going to do. And we're going to go in and we're going to use the STEP system where every trade's going to have a stop loss, a predetermined risk threshold. Every trade's going to have a profit target. What's our profit objective? Every trade is going to have our entry criteria, and we can automate these things. And this is what a lot of people used to call the set method. And I've got them in a different order, but you can easily see the word set in there. Stop, entrance, target. And then, you can set the trade and forget it. But the one thing I've noticed people over the years ignore is that position size. So that's why we use the STEP method and not the set method. The STEP method includes that appropriate money management and position sizing. And if you don't have good money management, how easy is it for you to get out of control psychologically, emotionally? When you have good money management, it keeps your emotions in check. It keeps the risk tolerances in check. It keeps your account intact. And you can live to trade another day. And that's, I think, the key to longevity in this game is just having that ability to impose your rules and order onto the market with a game plan for swing trading, with a predetermined stop loss, a predetermined profit target, and a predetermined entry point that automates the trade for you, and then having that discipline to keep your position sizing consistent. And with your account, it'll put you in good shape. And that's what we're going to do here as we get into our live examples. Now, some of you are probably wondering what that looks like. And this is the general idea that we're after. You know, if I'm trading a pullback or a breakout, I'm going to find that technical setup. Maybe it's a, pullback into its old support resistance zone or a rising moving average. And I can have a small risk entry based off the technicals where I can buy with the confirmation, put a stop loss below that newly formed support zone, have a small amount of risk in exchange for a good size profit potential, where you enter the price, you have a probable target, based off of what you know about the stock and what's likely. You have a stop loss to protect your assets if it goes against you, and then you position size, where I could take the exact same trade where, if I, put in 100 shares, I could risk $200. If I put in 200 shares, I risk $400. If I put in 50 shares, I could risk $100. And risk appropriate amounts of money for you, for your personality, for your account size. And then don't base the trade decisions off of the reward, like how much money you need to make. You need to base the decisions off of how much you're willing to risk. So that's how the STEP system works. Now, here are, by the way, some of the rules that we look for. And if you guys are interested in learning more about the STEP system, I'm just going to give you a teaser here. These are some of the entry and stop loss and targeting criteria and position sizing rules we use. So I'm going to start out here with the entry criteria. Look, we typically use the ATR, average true range, as a simple gauge on trades. I'll show you how we do that in a minute. We use maybe 10% of the ATR or 25% of the ATR above the confirmation, the price trigger level, to really confirm that it's moving in the right direction. So that makes sure, it just helps us avoid fake outs and the stock price like hitting resistance and barely poking its head up, and getting a too aggressive of a trigger. So we're going to use some filtration there. Then for stop losses, we have multiple techniques for, conservative to aggressive traders, for swing traders versus position traders, where you use a stop loss below a support zone, a price threshold that the market defines. And if I set up a stop loss in a price point where the market has to take out previously established support or previously established market low, it improves your odds of not getting stopped out just because you put your stop too close. And you can use 10% of the ATR, 20% of the ATR, 50% of the ATR, the average daily range below a support zone, so that it gives you a little buffer so that it only takes you out of the trade, not for just testing support and breaking it a little bit. It only would trigger you if it actually really breaks and starts to run. And it'll help you stay in trades longer, then have a better chance of actually winning. And then profit targeting, we use a really cool concept over at Tackle Trading. It's a proprietary concept. It's called the potential average yield. It's a systematic statistical, using historic volatility and measures of implied volatility to estimate what's actually probable on a profit target. And we call it potential average yield because it's based off of statistics and probabilities, and it gives you an idea of what the profit yield could be. And it's based off of averages and estimates, and not just, hope and optimism and greed. It's based off of actual mathematics. And you can actually have a really good mathematically probable target. And when you know what the stock's potential average yield is, you know how much the swing trade can pay. And that's a really, really cool concept. So we got and that's credited to Matt Justice. We called it potential yield for years. And I remember when Matt threw in the word average, because that's what it is, and we made the acronym PAY. It was a game changer for us, because how cool is it to know how much the stock can pay you before you take the risk? Matt occasionally is a genius. Mark is occasionally a genius. I'm even occasionally a genius. Even, you're a genius when your trades go for you, right? You're not so much a genius when they go against you. And then position sizing. We have disciplined rules. The STEP system kind of relies on no more than 1% of your account value risk tolerance. Experts will keep you 2% max, 1%, 0.5%. Predetermining that risk threshold and the consistency on position sizing is going to help you avoid a lot of problems. So if you guys want to take a screenshot of that, feel free to do that. But to really get the details in the application on this, that's what the STEP system is for. And we have an entire, how many hours of training are there on the STEP system? A lot more. It's a very thorough swing trading system that walks you through teaches you all the rules, the discipline, and everything you need to know about it. So what we're going to do now is we're going to go in and talk about how to buy and sell, how to buy to open with confidence, how to get into the trades, how to sell to close when you get to the profit or the stop loss. If you're a short seller, you need to know how to do the opposite. You need to know how to sell the open, and you need to know how to buy to close. And we're going to talk about how to use appropriate order types. See, this is one of those things where I didn't realize, guys, that when I first started learning about Robinhood, that they didn't have things like stop orders and limit orders and contingency orders. If all you had to buy with a market order, like your ability to control your entry and exit is really limited. Smash the buy button, smash the sell button. That means you have to be present to win. First of all, how many of you guys have day jobs? How many of you have lives? How many of you have kids that distract you all the time? How many of you have, life gets in the way, right? You need to be able to automate your orders. You need to be able to use those stops, targets, profit-taking limit orders. You can't just sit the market's like a watched pot. It has a really strong tendency to boil when you look away. Like, I could tell you stories about, the time we went to lunch and I watched a trading buddy of mine lose $90,000 while we were at lunch. Because he was relying on alerts and market orders, not hard stops. Don't feel bad for the guy. He made the money back. But, I've had those types of moments where, like, all of a sudden I get hungry and I leave the market unattended. I go grab some lunch. I come back. I'm like, what just happened? Yeah, expensive lunch, right? How many of you've all done this, right? So you just got to have the right order types. You got to know how to use limits. You got to know how to use stops. You got to know how to use stop limits. And you got to know how to use contingency orders. It's vital that you know those things. And so, stop markets, stop limit orders, contingency orders, they have to be an important part of your system. You can do it with stocks. You can do it with options. You can even use these things on fancy trades like spread trades, credit spreads, condors, you name it. You can impose automatic order onto the market chaos and avoid a lot of the heartburn that comes with purely discretionary trading. You got to keep that phone with you. Like, absolutely. In fact, I'm going out of town next week. I'm going to be out of cell service for a week. And you got to batten down the hatches before you go on vacation. You got those? I don't know on Robinhood. I honestly don't know, Jimbo. If you don't have fancy contingency order stop, I personally haven't used Robinhood, and I'm not about to.
Just give me your password. I'll take care of your account for you.
You'll take care of it? Just market order. You're good to go?
I'll take care of your account for you.
Well, even people who have brokers who can do these things, they don't. Like, one of my first really bad losing trades, I went and asked somebody who was wiser and smarter than me. They go, "Well, that's okay. Where'd you put your stop loss?" And I'm like, "My what?" Your stop loss, the order you put in to prevent yourself from losing all that money. You can do that? I had no idea. Absolutely. So you guys ready to go see some of this stuff live and actually look at some of the current stuff? And I've run a little bit over my time, so I'm going to do this quickly. Okay,
no,
guys.
I shot you a message. If you need to run a little bit over, I'm going to build off of where you end with stocks. So you can steal some of my time. I yield some of my time to you, Noah.
I yielded at you 3 or 4 times, but you didn't respond.
Cody, that was such a fantastic political move. Well done.
Well done, Cody. Well done. Well, I had a couple candidates lined up, and the first thing I want to do is this one, by the way, Overstock. I just pulled that off of the halftime report while we were sitting there. Tim popped open the chart of Overstock, and I was like, ooh, I had a little Pavlovian response to that bad boy, because that's a textbook step system swing pullback. We're going to look at that in a moment. But before we do, let's go look at our current watch list. So I've got a bullish watch list here that I'm going to pull up. Boom. Okay. And this is this week's stock report. Now, Greg Holmes put this out for us, and Coach Greg's an awesome guy, smart guy. He's going to teach you good stuff. This is this week's stock report. Nice little write-up, gives you some good information and advice on trading, and just Old Money Holmes. That name's going to stick. You guys wait and see. Old Money Holmes. Okay. Well, the stock report came out, and look at some of the candidates. Colgate Palmolive. That's breaking out right now. Let me reload that real quick so the scaling fixes on that. Boom. Check out that chart of Colgate Palmolive. It's breaking out right now as we speak. That is a good looking breakout. Okay, that report came out Sunday or Saturday, Sunday. You had it all over the weekend. Here we are, poised for a breakout. You can take advantage of that. There's one that already broke and probably people taking profits, a little $5 stock. Darden. Did you catch? How many of you caught Darden? Did you catch that breakout? Monday, Tuesday, Wednesday. Look at the profit taking. Buy at 80, target at 84, 85. Boom, nailed it. GLW. Well, that one broke out and ran. Doesn't help you to show the ones that already ran and made you money. HLT, Monday, Tuesday, Wednesday, profit taking. Boom. Into it. Oh, that one didn't work. That one went the wrong way, but it didn't trigger. Didn't ever trigger above the breakout high. So off this list, the one that really caught my eye was Colgate, ready to break out today, and Sony on the pullback. So we got a breakout on Colgate and a pullback on Sony. Beautiful chart setups. So let's take those over here and let's take a look at Colgate Palmolive. And let's implement some of our pattern recognition. What patterns do you guys see on this Colgate Palmolive chart? I know a lot of you have been trained market assassins. What do you guys see? We got a breakout setup. We know that much. Hey, Jake, how you doing? Glad to see you here, young man. It's a pretty good looking setup. Cup and handle, right, Seth? That's exactly what I see, a cup and handle. Little pull back into a breakout, okay? All right, now, psychological setup. Who is ready to buy Colgate at the highest high price it's ever been? Who's with me? Colgate Palmolive has never been higher. Let's do this, okay? It's got the pattern. It's got the setup. This is such a weird psychological frame for me, like buying a stock at the all-time high, but it's consistently a solid strategy. If you go track the performance of breakouts on stocks to all-time highs, every once in a while you get a fake out, but it's like less than 20% of the time. Most of the time, the trend is your friend. You might catch a rough timing on a breakout and get stopped out, but eventually the stocks break and run. Boom. Okay, so there we are. Now, if I were to implement some of the step swing trading strategies, I could use a couple of different techniques. One, I would feel comfortable buying above today's candle high. Some traders may already be in this, but I'm probably going to wait for one more day confirmation. Now, this stock is not a huge mover. It's got a $1 ATR, $1.07 average true range. That's the average daily candle. And it's a 77, call it a $78 stock by the time we buy. So I want you to think about this from this perspective. If this is a stock that moves $1.07 on an average day, that's what a day trader could expect on a breakout. Swing traders could get there. I'll highlight the cup and handle here for you a moment. The stock price is going to cost us $78. So I'm going to divide the average daily move by $78 price tag. We'll pay for it. And that's moving about 1.3% a day. If you move that, times 100 per percent, it's about 1.3% movement per day. Now, if you bought 100 shares and you used a 1 ATR plus trailing stop loss, what kind of risk would you have? Let's say you used a 1.5 ATRs. So you had like $1, $50, $60 trail stop. 50% of the ATR buffer. So you go take the ATR, $1.07, round it up to $1.60, half of the ATR plus, and you bought 100 shares and you got stopped out. What would your risk tolerance be? Trade went against you, didn't break out, faked you out. You'd risk about $150, $160, right? Okay, this is where position sizing would really come in handy. Well, what if you're only kind of like Colgate and you only want to risk a little bit less? Maybe you want to risk, $75. You could buy 50 shares, right? And you could take the exact same trade. Now, if I'm a pure like momentum trader, I'm going to buy the breakout and use an automatic trailing stop and just have it chase that for me. If I want to approach this more like a position trade type breakout, I'd probably identify this first support zone and put a stop loss underneath that in the 20 period moving average. And Ahmed, here is your cup and handle. Ready? Now, you have to use your imagination. And this cup looks like the cup you made your mom in kindergarten out of clay. It's all the way up here, and there's the little tiny teacup handle. So that's the cup and handle. Is it's knocking on resistance. Boom, it hit resistance, got knocked back down, came for the breakout. That's the whole cup and handle right there. Okay, tiny little teacup. So you see the pattern. And now that you see the pattern, you'll see that pattern over and over again. And a lot of times, the handle will be bigger. The cup looks like it went through the dishwasher and misshaped a bit. Textbook patterns occur most frequently in textbooks. But a breakout's a breakout. And the fact that it's just starting from a pullback, do I have to worry about the stock being overbought? It's only been running for like 3 days from the support zone it just formed. It's a big macro cup. Okay. But here's the point. This is why it works. When it got out to resistance, people said, no, it's not worth more than $78. It got out to resistance again. No, it's not worth more than $78. If it breaks out, it turns that negative no into a positive yes. People will pay more than $78. And an interesting psychological frame switches. If before it wasn't worth more than $78, but all of a sudden people start paying more than $78, the question then becomes, well, how much more? And if it is worth more than $78, then clearly it's not worth less than $78. And that's where the polarity of price switches. It's why old ceilings become new floors, because you could look at that exact same cup and handle pattern right here. There's a little one. Okay. Once it finally broke 75, the old ceiling became the new floor. So even if it breaks out and then comes back and retests, there's a really good chance it's going to stay above 78 as long as market sentiment stays bullish. Okay, so this is how you would go about planning a trade. You'd put in maybe a bracket order or a trail stop. And if I'm a swing trader, I'm going to probably do an automatic trail stop to capture the upward momentum and avoid the pullback. If I'm a position trader, I'll probably buy the breakout and put a stop loss down here below the pivot and only get out of the trade if it ends up breaking down instead of going up like I expect it's going to go up. If I really believe the stock price is going to rise, you can picture what those candles kind of look out and you forecast it out. And maybe it pops to 80 before the red candles start coming in and you see, some profit taking come back down and a retest. And if you miss the pop, you can always wait and buy the drop. You can always wait for the pullback. But why not try to capture that and scale into something and get a little profit working for you? Okay. So it takes time and practice. So, I could plan and place a trade on that really quick and easy, just from a swing trader's perspective, where I can say, okay, I will put in a buy with a trail stop. So I'll do like buy custom with a stop loss. And this is how simple a trading plan could be. All right, I will buy with a stop limit. I will trigger if it goes above 78. So I'm going to go 78.01. And then I'll say, but don't spend more than 78.011, maybe 12 or 13, somewhere in that ballpark. Try to catch the breakout and control my price entry. I'll make that order good till canceled. And then I'll use a trail stop. Hey, the ATR is $1. They're only pricing in about a 95-cent move on the option, on the implied volatility. I'm going to use a loose trailing stop, 1.5 ATRs. So $1.50. Rough ballpark. And make that order good till canceled. So now I have a game plan. My theoretical maximum risk is $1.50, barring some sort of gap or something crazy. If I did 100 shares, I'd be risking $150. The question I would have to ask myself is how much money am I willing to risk to find out if I can catch a breakout on Colgate Palmolive CL? And again, this is not an advertisement to buy or sell Colgate. For all I know, by the end of the day, market sentiment reverses. Okay. But the idea is you got to have that predetermined risk threshold. So if I'm willing to risk, say, $75, I only do 50 shares. If I'm willing to risk $150, I do 100 shares. If I'm willing to risk more, I could do more shares. You know, if I have a bigger account, bigger pain threshold, I could do 1,000 shares, whatever you're comfortable with. You know, I'll stick with the 100 shares. I could put in a profit target if I wanted to, but I'm kind of hoping to catch one that runs and just get my stop loss up to break even and let it run. I'm going to go ahead and send that one in. Now, last week, and I'm not sure if it was on this week's reports or not, we had CarMax on the report, KMX. And I did a little video on YouTube. If you go, again, you can find it on our YouTube channel where I followed this trade through. And this trade's still running. A breakout on CarMax had the same thing, a cup and handle. Ahmed, you'll like this one a little bit better because that cup and handle is a little bit more obvious. And was catching that breakout around 98. This trade we got filled at $100.07. That's our break-even price. This position has KMX, a $597 profit on 100 shares. And that same automatic trail stop that I put in on that YouTube video is performing really, really well. Whoops, I don't need the calculator. I meant to pull the chart down. The stop loss is currently sitting at about 103.75 or so. At this point in time, barring some sort of crazy gap, if the stock reversed, it would kick me out and I'd lock in probably a $300 gain or so. But if it continues to rise, you know, go, CarMax, go. I don't have to sit and babysit this. I don't have to watch this. I got the trailing stop in there. It's just chasing it. I've put in no extra effort into this than what I just showed you on Colgate. Now, guaranteed, not a guarantee that Colgate breaks out and runs just like CarMax has. But how many of you saw this one on the report 2 weeks ago? Or saw the YouTube video I did showing this trade off? I'm going to update that YouTube video today after I'm done here. That's a breakout trade, right? That takes the emotions and the decision-making away from me and puts it onto my system and my rules and that step system and rules that protect me, that keep me safe, that keep you safe, that help you take calculated risks. Because, well, no, if you don't take the risks, you don't get the reward, right? So that's how you impose order on the chaos of the market. Through discipline, through order types, through having a systematic approach, rules of engagement. And the other stock that I really, really liked, so I can get this done and hand it off to Cody here.
I was about to say, I'm about to reclaim my time.
Sony, check out that beautiful pullback.
Oh, that is a very nice chart there. Why don't you show a stock buying order on that, and then I'll directly transition into what a option order on that same stock.
Well, and that's the beautiful thing. You could do it with options. You can do this on futures, on Forex. I mean, once you learn good swing trading methodologies, you can apply it as a day trader. You can take it down a time frame and apply the same concepts to day trading. You can expand those time frames out to weekly charts and become more of a position trader. You can even do it on like monthly charts as an investment strategy. And it's relatively simple. Buy breakouts, buy retracements, learn to lock in gains or adjust or get stop losses to break even. And one of the simplest things you can do is buy a breakout or a retracement, get your stop loss up to break even and just let it go. Just lay off of it and then take some profits off the table once you get a profit objective and let the rest of it run. And you might catch a stock that, you know, how many of you could have caught the breakout back at 65 and still be holding it up here at 80? That'd be awesome. That's how you grow wealth, is to let stuff run. And so what makes this chart beautiful in the STEP system is it broke to a new high with great momentum off of a good earnings announcement. It pulled back profit taking into this old resistance support zone. It's got catalyst, the 9-period moving average, the 20-period moving average, and we have an upward confirmation in price. How do you know when it's done going down? It starts to go up. There's a confirmation trigger. You could put an order to buy above that and a stop loss down below it. And we could even put a target out there at 85, and I can do what's called a bracket order. I can go buy custom with a bracket. And I'll say, hey, you know, that might be enough confirmation to buy. Let's go above the high. Let's buy if it goes above 81.08. So I'll put in my order, hey, buy stop limit, get me in above 81.08. And if you like these ideas of actually imposing, you know, this kind of system, it's really helpful to go through the STEP system. And, you know, to get those scouting reports every week, which is part of your pro membership with Tackle Trading, you got to check out the free trial if you haven't. And I shout out to all of our pro members there, by the way. This is what you guys do, you know, day in and day out, week in and week out. Let's not spend more than 81.020. And then we'll set a profit target. I think this can pop out to 90. So I'm going to set a target out at 90. You know what? 89.75. That'll improve my odds. And then let's use a standard stop loss, and I'll just put a manual straight stop loss down below that support zone at 78.90. So 78.89 for a stop market. That's a manual, not an automatic trail stop. I'll make those all good till canceled. I'll stick with the same 100 share position size. Again, entry price 81.20 to 78. That's got about $300 risk in it. And I'll send that bad boy in, and voila, that's a bracket order. I literally don't have to look at that trade again because I've got it kind of set up. This is what I call the Ron Popeil method of trading. Set it and forget it. And on that note, ladies and gentlemen, and faithful, you know, pro members and new people to us, come on in, get to know us, join us at Tackle Trading. And